Hi everyone. In this video we'll conclude our discussion of the equity method. A series of losses incurred by Argent or other factors that could indicate an equity method investment's fair value has declined to an amount below its carrying value. If that decline is viewed as other than temporary, the investor should recognize an impairment loss in net income and reduce the carrying value of the investment to fair value in the balance sheet. The investor then continues with accounting under the equity method. When the investor's level of influence changes, it may be necessary to change from the equity method to another method. When this happens, no adjustment is made to the remaining carrying amount of the investment. Instead, the equity method is simply discontinued and the new method applied from then on. The balance in the investment account when the equity method is discontinued would serve as the new cost basis for writing the investment up or down to fair value on the next set of financial statements. When a change to the equity method is appropriate, the previous method is discontinued and the balance in the investment account at the date of change, including any unrealized gains or losses that occurred prior to the date the investment qualifies for the equity method, is used as the starting balance for applying the equity method. Any cost of acquiring additional shares is added to that balance, and going forward, that balance is adjusted for the investor's portion of the investee's earnings and dividends. A disclosure note should also describe the change. When an investment reported under the equity method is sold, we recognize gain or loss if the selling price is more or less than the carrying amount of the investment. For example, let's continue our illustration and assume United sells its investment in Argent on January 1st, 2022 for $1,446,000. At December 31st, 2021, the balance in United's investment in equity affiliate was $1,545,000. That is the carrying value of the Argent investment. So United sold the investment at a $99,000 loss, calculated as the selling price of $1,446,000 minus the account balance of $1,545,000. The journal entry to record the loss is debit cash, $1,446,000, debit loss on investment included in net income, $99,000, credit investment in equity affiliate, $1,545,000. Illustration 1217 in your textbook provides a side-by-side comparison of the fair value and equity methods and highlights several aspects of these accounting approaches. To record the purchase of an investment, we use the same basic entry for both approaches. The two approaches differ in whether we record investment income when dividends are received and whether we recognize unrealized holding gains and losses associated with changes in the fair value of the investment. The differences in how the two approaches account for unrealized holding gains and losses result in different carrying values for the investment at the time the investment is sold, and therefore can result in different realized gains or losses when the investment is sold. Regardless of the approach, the same cash flows occur, and the same total amount of net income is recognized over the life of the investment. This is a very useful illustration, and the page should be flagged for future reference. Here's a concept check problem for you. KB purchased 40% of the stock of Rightco, Inc. for $500,000 on January 1st, 2021, and accounts for the investment using the equity method. At January 1st, 2021, 40% of the fair value of Rightco's net assets is $500,000, and 40% of the book value of Rightco's net assets is $200,000. One half of the difference is attributable to land, and the other half to a building being depreciated over 10 years. To account for this difference, during 2021, KB would reduce its investment in Rightco by A. $300,000, B. $150,000, C. $15,000, or D. $6,000. Please pause your video while you do your calculations and decide on which is the right answer to the problem. Then start the video again to check your answer. The correct answer is C, $15,000, calculated as follows. 40% of Rightco's fair value in its net assets is $500,000. 40% of the book value of Rightco's net assets is $200,000. The difference is $300,000. Half of that difference is attributable to the land, which is not depreciated, and half is attributable to the building that is being depreciated over 10 years. We can assume straight line depreciation. So $300,000 divided by 2 equals $150,000 attributable to the building divided by 10 years equals $15,000 depreciation adjustment per year. Well, that's all, folks. See you next time for Chapter 13.